Apple dropped 5.9% in a single day. 107 million shares traded, 2 to 3 times normal volume. The question is, was that the bottom, or just the beginning? Zoom out a month. From the May 29th peak of 315 to the June 25th close of 275, that's an 11.32% correction in 4 weeks. And the momentum signal is alarming. The RSI, a gauge of buying pressure, collapsed 48 points in 4 trading days. From severely overbought at 80 to deeply oversold at 32. That's not an orderly correction. That's panic. Why did Apple fall this hard? 4 forces hit at once. First, a memory chip shortage is pushing up component costs. Apple raised MacBook Air prices 20%, from $1499 to $1799, to protect margins. That's not pricing power. That's desperation. Second, the tech sector rotation. The AI liquidity bubble of early 2026 is deflating. Third, sticky inflation, PCE at 4.1%, keeps rates higher for longer, compressing multiples on high PE stocks like Apple. Fourth, Fed leadership uncertainty, with Warsh potentially taking the chair. Here's where it gets interesting. The technicals are screaming buy. RSI at 32, price below Bollinger Bands, massive capitulation volume. Historically, this setup produces a reversal 65 to 70% of the time. The golden cross is still intact, 50-day above 200-day. And Apple generates $101 billion in free cash flow, buying back $90 billion a year. But here's what the bears see, and it's harder to dismiss. Net margins dropped from 29.3% in Q1 to 26.6% in Q2. Free cash flow is falling, down 2.3% trailing 12 months, down 9.2% year over year. The buyback is being funded with deteriorating cash, not growing cash. The killer signal, the VWMA divergence, is at negative 6.5%, the maximum in the entire dataset. This means institutions were selling into the panic spike, not alongside retail. When smart money exits during a capitulation event, that's not a sign of panic selling. That's a coordinated exit. 7 AI analysts ran the full committee. Technical, sentiment, news, fundamentals, a bull versus bear referee, a trader, and a portfolio manager. The unanimous ruling: hold. Not buy. Not sell. Hold. Here's the specific plan. Scale out 30 to 40% of your position now at 275 to de-risk. Keep 20 to 30% with a hard stop at 268. That's the 200-day moving average. Allocate 5 to 10% as a speculative bounce trade, triggered only when MACD turns positive or RSI climbs back above 40. The next 4 to 6 weeks of earnings guidance on margins and cash flow will tell you whether this is a tactical dip or a structural deterioration. Educational only, not financial advice. Do your own research.